All right, welcome to today's Stock Market Brief Show. Let me just start off by saying that I already know a lot of people are going to think that this episode is going to come off bearish. So I just want to go ahead and let you know that's not my intent here. It's been to prepare you for opportunities that arrive and make sure you're not part of the bigger crowd that tends to get in at the wrong times and get out at the wrong times. You see this thumbnail over here? It was from a video about a month ago. It was at the bottom of the market basically, or pretty close to it. And it was saying that the panic was spreading and it's about to get worse. And I said, this is urgent. And what we did in that video was we talked about some various signal charts that was just honing in on what I meant visually and from a price action perspective of just how bad it was from a panic perspective. In today's video, I'm going to be flipping the script while using these same exact technical indicators. On yesterday's or the last video I posted, we talked how the pain trade has now turned into the FOMO trade. And you can see over here, we got the Mighty Ducks flying V from this low, basically straight up in the markets, going positive on the year and really a stone's throw away from all-time highs. Now, if you remember this video, this is one of the charts that we shared. It was the S&P 500 on the weekly time frame, but what we shared here was the PPO, and we use a specific little number down here as far as the settings go, 1,5, and what that shows you is how far the weekly candle is from the 5 EMA. It gives a good idea as far as times throughout history that we've seen big extensions, and it allows us to kind of go through our charts and through the history to see, hey, what happened the last time we were at these levels? Well, as you can see, I posted this April 4th. We were about 8% away from that, and you can see over here, we saw a massive rubber band snapback. And what are we looking at right now? Well, now we're very disconnected from the weekly 5 EMA. You can see that little purple line down here, and we're way up here. Now, we still got one trading day left in the week. So how does this resolve itself? It doesn't necessarily mean that we have to have the same type of reaction, what we saw from the bottom, but it could mean a stall out. It could mean a pullback. It could mean a consolidation where price action eventually slows down enough for the weekly 5 EMA to reconnect. So what does this actually look like based on history the last times we were this disconnected from an average that we typically connect with every single week for the most part? We sometimes go a week or two without tagging it. But what's that look like? Well, right now, this is a chart dating back to 2011. And as you can see currently, right, it's just Thursday's close. We still have another day left. So we didn't technically close at these levels, but I'm bringing this up now because, well, I want to get ahead of it. Right now, we're 4.09% away from the weekly 5 EMA. Now, the last time that has happened actually was over here coming out of the pandemic bottom. And I'm going to bring up these charts and show you what it looks like. Prior to that was actually over here during 2011, and I believe that was during the times of Operation Twist. Now, you can see these two times, we didn't quite get their weekly closes, but, you know, it closed right by there. So let's go ahead now and look at the S&P 500 and what it did each of these instances while we were this disconnected from that weekly 5 EMA. So if we date back here, you can see in 2022, the times that we actually did not get that extended, but perhaps maybe intra-week we did. What happened? Well, this was a monster rally back from these lows, and it happened to consolidate and fade down. This one actually kind of rolled over completely. And then this right here was actually the 2022 bottom in October. We got a big fat 9%, I believe, inflation report that day, and it actually marked the bottom. Go figure, bad news on a way down, but it turns up is actually good news for the market. That's why they call it a discounting mechanism. And then over here, you can see that was the other time that we came very close to that 4% above it, and we saw some consolidation and a little bit of a pullback before heading higher. Now, prior to that, we had the pandemic. What did that look like? You can see we went through the pandemic, saw a nice big rally up. We started to get pretty frothy from that weekly 5 EMA, and we just pulled back, we saw a move higher, we came back and we consolidated. That's all we did, but it had some volatility there. The next time, shortly thereafter, we saw a massive rally up, and that led to quite the pullback and quite the volatility here too as well. Now, prior to this and prior to that, we had 2011. So let's go ahead and take a look at 2011. Well, we had that massive volatility, boom, 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 a new low was formed, and then we started going on our run. And it wasn't until here that we started getting very disconnected from the weekly 5 EMA, and price then had to consolidate. It pulled back a little bit more, and we saw more volatility. So as it stands right now, the reason I'm bringing this up is because this means, based off of history, we're approaching an area that's likely to get consolidation and or a pullback. And I'm bringing it up again because when we were down here and I was calling it out on this video, I had the same people say this time is different. Your technical indicators, they don't work. This and that and this and that. But if you're open to the idea of looking at past history, and maybe it's not going to repeat itself exactly, but like Mark Twain says, it often rhymes, it creates opportunities from big extensions. Now, if you take a look right now at the SPX on the 15-minute time frame, and you're wondering, well, where are we in no man's land up here? This is a big move. It's causing the FOMO. Well, that's because we're approaching and approached today the 2 standard deviation weekly expected move, which is a very large outsized move in the S&P 500. In fact, over the weekend, we had news. The weekly expected move was down here, and we basically started through it, came back and tested it. And from that point, the market being so wrong, cranked higher all the way to reaching to a 2 standard deviation move. Now, for those that don't understand just basic statistics of a normal distribution curve, take a look here. This right here is a 1 standard deviation. So 68% of the time, you'll close kind of within this range. More specifically, though, since you're averaging strikes that are above and below it, you typically come and you tag it 68% of the time and or within it 68% of the time. Now, in the S&P 500, it's not really quite a normal distribution. In fact, the math has been done, and you're looking at more 75 to 80% of the time that you'll close within these weekly implied moves. Now, we're at a 2 standard deviation move, and it closes within this 95% of the time. Another way of saying this is only we'll just say 4.5% of the time, it closes outside of it. And right now, we're basically at it. So there's only typically a 4% chance, right, and some change that we close outside of this from a weekly perspective. And we're about there, which is pretty rare occurrence. And that's what really creates this FOMO. I want to talk about another signal chart we talked about on April 4th, and that was the Bullish Percent Index for the technology sector. Now, another thing that I got comments on saying, wow, but these things don't work this good this time because XYZ narrative. Okay, well, if you were paying attention to this and you were happening to dabble into some technology stocks, you did pretty darn good, right? Because we got a reading down here at like 7%, and the only times that we've seen this throughout history was like 6 other times, and that happened to be at some pretty significant turning points in the market, from a low to, a big bounce over here from the pandemic low. 2022, we saw some nice rallies from. So why am I bringing this up now? Well, let's flip it on its head, because what happened? Well, the market from those lows right over here rallied straight up to a very extravagant reading. The technology sector flew higher, and well, it's at a 94.37% reading. How many times in history has it been here? Twice throughout all of history have we gotten a reading this big. However, it doesn't nearly look as as strong of a reading or as powerful of an indication of a move than this specific chart looking at the bottom end of it, like the oversold conditions. So I looked over here and I was like, okay, well, what happened in 2019? And then what happened over here? This was coming out of the, .com bubble. Well, let's go ahead and take a look, shall we? So right over here was when we started getting those very frothy readings in April of 2019. What happened? We actually cruised higher, and then we saw some consolidation and pullback, and then we saw a rip higher, and it kind of went down, and then we just kind of chopped around actually for quite some time. What happened back coming out of the great financial crisis? right? This is where we got that reading and we saw a little bit of a pullback. But guess what? This is coming out of the lows. So was this meaning that, hey, I'm going to get all bared up right now because we're getting extended? Well, not necessarily, because the market ended up going higher. I will say that once we got this reading, we did go sideways, albeit with some nice movements for some time right here. That's quite a few months, right? Over here was October and of 2009. Well, going into 2010, we were in the same area midway through the year. So that's pretty wild stuff. Now, I showed you the Bullish Percent Index chart for the technology sector. You can look at discretionary. It's getting up there too with the high RSI. You can look at the financials, which is another important sector. It's getting up to an extended reading on the RSI, not as much over here on the exact reading on the Bullish Percent chart. The BP-SPX chart has cranked into overbought condition, which we've been going over. And typically when you cross back down through 70 is actually when we see more volatility typically pick up. The BP-NDX chart has a little bit of a negative divergence, but we didn't get really too overbought in that condition. The BP-NYA, the NYSE Bullish Percent Index, RSI has been in oversold condition. And then the industrial average also sitting there in an over condition too. I think I've been saying oversold, but overbought condition. A couple other signal charts over here is the NYSE McClellan Oscillator. A divergence has been building here. We've been pointing this one out. As the market's grinding higher, what is the internals telling you? The internals are slightly weakening, putting in a lower high, while price action's putting in a higher high. Throughout history, I've been tracking this, and you can see multiple instances where this played out to a pullback in the market. Another important signal chart that I like to use is the put to call ratio, and I like to apply a 10-day moving average to it. When I apply the 10-day moving average, I like to see it get back below 8 and then cross back up through, which is more bearish signal. The last time that happened was right over here in February as the market was pressing new all-time highs, and it gave us the good insight knowing that this could very well be a bull trap breakout, and it turned into quite the bull trap breakout. And then when you get really extended up here and cross back down through 1 and 0.95, this zone, I like to use that as a signal to potentially get more exposure. In short, what is this telling us? Things are very bearish here. Things are very bearish down here. Now, if you see this purple line that's shaded, that is the put to call ratio, not the moving average, but the put to call ratio. And this recent print was down here at about 0.7. And that's a pretty frothy reading, meaning that things are pretty bullish here. And the more we stay in these ranges, this is going to cross down through 0.8. And this tells me, hey, you might want to consider locking in some of the gains, waiting for consolidations, and waiting for the market to kind of breathe in what just happened. Think of yourself running up a mountain that goes very high elevation. You run, you run, you run, and then the higher you get up the mountain, the less oxygen that's up there. So you typically have to slow yourself down, take a breath, and consolidate before heading higher, right? If we take a look at the CPC, this is the put to call ratio, but for equities only, right? The total put to call ratio is the one I just showed you. This one is specifically just for equities. And I apply a 5-day moving average to this just to give an idea of, where we've been through, in the past. Is it bearish? Is it bullish? Well, right down here, it's a pretty bullish print down at around 0.5. The last time we were down here was, right in this range of the S&P 500. And you kind of stayed down there. But what did price action do? Well, we chopped around. Prior to that was here in July going into August, right in about this area before seeing a little bit of a pullback there. So if this starts picking up, obviously that can put the sideways movement into the S&P 500. And if it keeps going spikier and moving higher like that did over here, it could put the kibosh to it. So that's what we got to watch for. If we look at back month versus front month volatility, this came way from the lows. It's coming to more neutralized state and even coming to an area where now it's getting to an extension. Now, we're still pretty far off of it. 1.2 tells us that back month volatility is 20% higher than front month. And when you get in those areas, you could typically see periods of consolidations like we did over here. You can go back through history. We consolidated and pulled back over here. Many different times you can go back through history. And then when it gets below 1.0, I like to look for the price action to start basing out, consolidating, and start to head higher, which is really what we got. Okay, so we went over a lot of signal charts. We went over why it's important to look at these signal charts from a price action perspective and how it's likely to get some sort of a consolidation pullback in the very near future. And that's not me just saying that. That's just based off of what has happened in the past. Hey, prove me wrong, right? Prove me wrong. That's totally great. But likelihood of it even going higher and then coming back to where we are right now, the probabilities of it are currently increasing. And what I found interesting today in today's price action was if you take a look at the 11 sectors that make up the S&P 500, right? We've been showing the S&P 500. We show a couple of those bullish percent charts for like the technology sector, discretionary, and so forth. But what are the names that have been kind of beaten down or not going anywhere? Well, consumer staples, we had healthcare and utilities, right? I think real estate too. I don't remember what that chart looked like, but those are some of the names that have been not going anywhere or heading down. So what I find to be very important here going into tomorrow's trading session, next week's trading session, is not necessarily looking for just the market to go down, but what is happening underneath the surface. Where is money rotating to? Or is it going to be a full-blown capitulatory type pullback, which is a whole nother problem in and of itself? My personal opinion is you got to look for where strength is rotating into, and that could be to where we've seen some weakness. So my thought here is kind of what we saw today. You see utilities, consumer staples, even healthcare start to see a little bit of strength relative to the S&P 500. If the S&P 500 gets a pullback, these are probably the names that are going to show that relative strength to be keeping an eye on. That's the thoughts right there. If we take a look to going into tomorrow's trading session, we have a daily expected move that can bring us up to and around 595 to 597. That's the vol range up in here. And then beneath us would take us down to the upper monthly implied move, which, by the way, we're outside of the monthly expectations of the market right now, and we're slightly above last year's closing price. So to come down here, I think it was over here when I was talking about it on a live stream, I said the likelihood of pulling back to this is very likely. And it did, and it got next to that week-to-date VWAP. So I'd be watching that week-to-date VWAP and these lower areas if price were to come in. If it keeps continuing to go up, right, the FOMO, the fear of missing out is going to intensify and increase, but that does not change the signal charts that we just recently discussed. Hope today's episode helped out. I'll see you on the next.